Hey guys, so it's beginning of March and that means that we have only 5 weeks left till the tax deadline. Only 5 weeks, just hanging in there. So I'm reviewing and preparing lots of tax returns like we all do, and I figured maybe I should record a video about my findings, about mistakes I found in somebody else's work, sometimes even in my own work, because we all humans. So today's top 6 would be listed right here on the screen right now, and I'll try to do it weekly. Let me know what you think. Let's start. So the first one I want to talk about is entering or totaling 10 interests from different tax forms. So I used 1099 interest as example. So let's say we received two 1099 interest from Bank of America, and we saw it's like $10 on one and $5 on another one, and we okay, let me just enter Bank of America $15, right, into interest. But that would be a mistake, and I'll tell you why. Because technically IRS will be matching what we will send as a tax preparers when we e-file. So what will happen is they will send us a matching notice. We'll say, they would tell, okay, we actually, it's nice that you reported on another one. They don't really see you. So we need to make sure we enter two 1099 interests separately. So it's not going to be, so we won't receive any matching notice from IRS. So that would be a mistake or omission number 1. Safe harbor election. So that is extremely important, and sometimes we think that's obvious, right? So in order for us to deduct expense any depreciable assets over below 2,500, we need to make sure we add this statement to the tax return. So before 2016 it was $500, after and from 2016 till now it's 2,500, right? So how do we add that statement? So we have to go to the tax return, check the box in certain softwares, and sometimes we just need to manually add the statement to tell the IRS that we expensed the depreciable assets below 2,500. Why it's important? Because the client can take additional deduction, and for us, and when we do this kind of stuff, we need to make sure not to forget about this statement. So that's important. So anytime you see you have depreciation schedule on your tax return, if it's a business tax return or it's an individual Schedule C or Schedule E and you have assets, I would recommend to add this safe harbor, the Minimis election statement. Another note, don't confuse it with Section 179, because Section 179 is a tax code when you can deduct full amount of the assets the same year, but it's limited to the net income. So if you have lost that year, you can't take any Section 179. So those are two different things, right? Safe harbor, you can expense everything till 2,500 of cost, and then Section 179 is a tax code that allows you to expense certain things until certain thresholds. Awesome. Let's move on to the next one. So another mistake I saw, in certain softwares you can enter 1099 NEC or 1099 miscellaneous separately instead of entering under Schedule C for business income. So what happens when we enter it separately and we don't have any business income, right, that year, it automatically would flow to other income on Schedule 1. And that could be for this example, we assume that 1099 income is for business income, right? So what will happen is that QBI is not going to take that into calculation of QBI income, because on QBI income, only income from Schedule C would flow. Another way, sometimes certain softwares allow you to mark 1099 miscellaneous that it's supposed to flow to Schedule C, so then we should be okay. But if the software doesn't allow us to do it, we need not to enter under 1099 miscellaneous entry, but make sure to enter income under business income on Schedule C. And for example, you can see this form for QBI deduction. As you can see, only business income is included. So it will probably flow only from Schedule C. state non-taxable interest from the brokerage accounts. So we all know this like 1099s and they're like super long, but pay attention. If you have this tax-exempt interest, it means it's not going to be taxable on federal level, right? But it might be taxable on a state. So you have to find this statement or a page where it shows percentage allocated to each state. So for example, on this example, you can see, and I'm going to show 1099 right now. So you see this percentage is California percentage. I'm using California as example for a state. So it means this amount is not going to be taxable to this state. So what I have to do, I have to multiply full amount of tax-exempt interest by this percentage and enter it as tax-exempt in California. And the rest would be taxed. So don't forget to do that so you don't have to overpay this state taxes. For purchasing a new house, you can deduct property taxes from your closing statement. So in example like this, you can see the purchase price of the house. And also on the same side, you can see the property taxes. It means that client, when they did purchase a house, he actually paid for those property taxes because they're part of their closing cost. So in this case, we can easily go to Schedule A and include those taxes as part of our Schedule A. Well, this is it. This is top 6 mistakes I found the most important that I found this week. Let me know if you find this helpful, if I should continue recording those weekly updates or not. And as a reminder, I also sell online courses that I teach how to prepare individual and business tax returns in the software of your choice. You can visit my website and see what I have. And also please comment below with any suggestions for any videos I can record or anything. I would love to hear from you. Have a great day.